$5,000. A number that seemed impossible just 2 years ago is now the reality on every trading screen in the world. Gold has officially breached the $5,000 mark, sending shockwaves through the global financial system. But as the headlines scream all-time high, a much more dangerous question is being asked in the shadows of the market. Is this the ultimate peak before a crash, or are we witnessing the permanent devaluation of the paper currency in your pocket? Today we're looking at the hard data. If you're holding gold, should you take your profits now? And if you're sitting on cash, is it too late to protect your wealth? Let's dive in. To understand if $5,000 is expensive, we have to understand why we're here. This isn't just about supply and demand. We are witnessing a perfect storm of 3 factors. First, de-dollarization. Central banks in the East have been dumping U.S. treasuries at a record pace, replacing them with physical bullion. Second, the 2026 inflation spike. With the cost of energy and food remaining high, gold is doing exactly what it was born to do: preserve purchasing power. And finally, geopolitical uncertainty. When the world feels unstable, investors run to the only asset that has never reached zero. But here's the catch. When everyone is talking about gold at the dinner table, that is usually when the smart money starts looking for the exit. Is this a bubble? If we look at the inflation-adjusted peak of 1980, gold would actually need to be closer to $7,000 today just to match that high. By that metric, gold is actually underpriced. However, the RSI, the Relative Strength Index, is screaming that gold is overbought. History shows that every time gold makes a vertical move like this, it eventually takes a breath. A 15% to 20% correction is not just possible, it's healthy. If you buy today at the top of the candle, you must be prepared to see your portfolio go red before it goes back to green. Are you a trader looking for a quick flip or a stacker looking for a 10-year hedge? There are 3 reasons the bears are selling right now. 1. Profit taking. If you bought gold at $1,800 or $2,200, you have more than doubled your money. Selling a portion of your physical gold now to pay off your mortgage or buy real estate is a rational move. 2. Interest rates. If central banks decide to fight this inflation with Volcker-style high interest rates, gold, which pays no dividend, could lose its luster compared to high-yield bonds. And 3. The rise of digital alternatives. While we love physical gold, some of the capital is flowing into Bitcoin and other hard assets that are easier to transport across borders. But the bulls have a much stronger argument. Global debt has reached levels where it can never be repaid in old dollars. The only way out for governments is to inflate the debt away, which means your paper money is programmed to lose value. Furthermore, gold mining supply is stagnant. It takes 10 years to bring a new mine online, and we haven't had a major discovery in a decade. If the institutions, the pension funds, and 401k providers start moving just 2% of their portfolios into gold, $5,000 will look like a bargain. We could be looking at the great revaluation of assets. So what is the strategy? If you have 0 gold, buying a small amount now, even at $5,000, is about insurance, not profit. You don't buy a fire extinguisher because you hope for a fire, you buy it so you're ready. However, if you are looking to invest heavily, wait for the first 10% dip. For my long-term stackers, hold. Do not let the volatility shake you out of the best performing asset of the decade. Remember, gold is the only money that doesn't have a reset button. If you found this analysis helpful, make sure to hit the subscribe button. We'll be tracking the silver market next week, and trust me, that story is even more explosive. Stay safe and stay invested. Now that we've covered the big picture, let's look at where we stand today, March 17th. Gold is currently fighting to stay above the critical $5,000 psychological barrier. We are seeing a healthy consolidation after the massive rallies earlier this year. In Turkey, with the dollar sitting near 44.20 Turkish lira, we are seeing gram gold prices around 7,130 Turkish lira. If you are looking at your screen and seeing red today, don't panic. This is what we call a buy-the-dip opportunity for long-term builders. Remember, the CBRT, Central Bank of Turkey, just revised inflation expectations upward to over 25% for the end of the year. Your goal isn't to time the daily fluctuation, it's to outpace that 25%. A common question I get is, how much should I actually own? For a general wealth building strategy in the current climate, many experts suggest the 80-20 precious metal split. That means for every 100 grams of gold you buy, you should consider the equivalent of 20 grams in silver. Why? Because the gold to silver ratio is currently sitting around 62. Historically, when gold hits record highs like $5,000, silver tends to rubber band afterward. By holding both, you are protecting your base with gold while leaving room for explosive growth with silver. In Turkey, we have unique ways to invest. You have two main paths, physical or digital. Physical gold, like the Çeyrek or Cumhuriyet coins from the Grand Bazaar, gives you total control. There is no counterparty risk. However, watch out for the spread, the difference between buying and selling price. Digital gold through your bank is more liquid and has tighter spreads, but remember, in a true global crisis, physical is king. My strategy? Keep 70% in bank gold for easy trading and 30% in physical for long-term emergency security. So, we come to the final question. Is it too late to buy? When gold first crossed $2,000, people said it was the top. When it hit $3,000, they said a crash was coming. Now, as we sit here in March 2026 with gold testing the historic $5,000 level, the same voices are calling for caution. But here's the reality. Gold isn't necessarily getting expensive. It is our paper currency that is losing its strength. In Turkey, with inflation hovering above 31% this year, waiting for a better price is a dangerous game. Every month your money sits in a standard cash account, it loses a piece of its power. If you wait 6 months for a 5% drop in gold, but the lira devalues by 10% in that same time, you haven't saved money, you've lost ground. Wealth building isn't about timing the market, it's about time in the market. Think of gold and silver as your financial insurance policy. You don't buy car insurance because you plan on having an accident today. You buy it so that if the unexpected happens, you are protected. In a world of rising global debts, central banks, including our own right here in Turkey, are hoarding gold at record levels. They aren't doing this for a quick profit. They are doing it for sovereign survival. If the biggest banks in the world are protecting themselves, shouldn't you? Here is your 3-step action plan to start today. Audit your savings. Look at how much cash you have sitting idle. Start small. You don't need to buy a kilo. Start with a single gram or a silver coin. Be consistent. Use the dollar cost averaging method we discussed. Buy a little bit every month, regardless of the news of the day. Remember, the best time to start building wealth was 10 years ago. The second best time is today. You are building this for your future self and for the generations that will follow you. If you found this deep dive helpful, please hit the like button. It helps the algorithm show this to more people who need to protect their savings. Subscribe to my channel for weekly updates on the Turkish and global markets. Let me know in the comments. Are you buying gold at $5,000 or are you waiting for a correction? I read every single comment. Stay informed, stay protected, and I'll see you in the next video.